I went out with my friends at a bar. We were like popping bottles. And you know, like as a guy, the male bravado comes out. He's like, yo, like, what do you think you could do with the money you have right now? I'm like, yo, like I'll do whatever. What do you think I should do with my money right now? And he's like, yo, you should buy a house. I'm like, I'll buy a house right now. Like I'm just talking like out of my ass at this point. Right? I kid you not. Like he completely sobers up in my face and he's like, I'm a realtor. Like, let's buy a house. I'm like, you must be drunk. This must be like another phase of your drunkenness. The next day I'm waking up and I get this message from this guy and he's like, here are some plans, the down payment structure. Let's pull the trigger on this.
Bro, in less than 24 hours.
24 hours. I'm like, that's crazy. But in my mind, I'm like, I rationalize. I'm like, why not? Yeah.
Welcome back to the Black is the New Rich podcast. It's episode 11, and I'm gonna let you guys know this episode is very selfish to me because my financial literacy, I wanted to get it up. So I needed to search for a mortgage expert and I found him. And you know what? I'm gonna let you introduce yourself.
That's a lot of high praise. I'm not gonna lie. I'm Mr. Price Match Poppy, Royston Simon, jack of all trades. I'm a mortgage agent. I'm a real estate investor. I am a co-host of my own podcast as well too. Content creator, all things above, and all to sum it up as well, a brand new dad. So
congrats to that.
Appreciate it, man. Appreciate it. So yeah, that's a really big title to live up to for this episode. But you know what? I'm up for the challenge.
All right, bet. So before we get into it, I just want to know. I ask everybody this question: what's the best advice that you've gotten and the worst advice that you've gotten?
The worst?
Yeah, we can start with the worst.
You know, we can start with the best because the worst is that's a tough one. I never really had anybody ask me about worst advice before, but best advice that I think I've gotten, I would say, is to not be afraid to make mistakes. It sounds so simple, but when you really dig deeper, it's really just a matter of like just doing whatever it is that you feel most inclined to do. Dope. I'm someone who I could often say, like, in my past, I've been someone who suffered a lot from like analysis paralysis, and you spend so much time. So you have an idea, and maybe you're like, okay, this could be really cool, or this could be something that was really dope, and then I maybe overthink it, or I analyze it too much. I'm like, like, what if it goes wrong? And then the more time you give yourself to think about something, the more likely you are to kind of talk yourself out of it. Not to mention, I'm someone who also really used to like rely on other people's opinions of something. So I used to go to like maybe my mom, or I go to my dad, or I go to my best friend, like, yo, what do you guys think of this idea? And they're not even having experience in that idea itself. Or maybe they have their own inhibitions about it, and then they can maybe talk
biased opinion
as well. So all those things are like the perfect storm to kind of maybe derail you altogether, or maybe not make you put the best foot forward. But then when you actually do it, if you get the courage to ever actually try it, you're like, yo, this isn't so bad after all. Or I did a lot better than I expected. Or it gave you a really good outcome that you weren't really even sure was possible, right? So I'm now like a risk taker, and I'm someone that just like, I'm glad that I'm not afraid to make mistakes, because I feel like that's when you have the best outcomes and you grow the most as well too. So 100%. That's some advice I always keep near and dear to me.
All right, dope.
Worst advice though?
Yeah, let's get into it.
That's tough. I would say, you know what? I don't have a worst advice that's been verbally given to me. I think I would just chalk it up to influence. Like, I think I was just surrounded by a lot of bad influential factors that may have maybe handicapped me a little bit, maybe derailed me a little bit, and maybe just shrunk me a little bit more than I should have been for a great portion of my time. And I think that's probably one thing. Mindset.
I get it.
Mindset is so huge. And like I said, with the not being afraid to make mistakes, right? If you are someone who's also greatly impacted by your environment and your surroundings and the people that you kind of surround yourself with, that can be something that really dictates what you end up doing. It's no joke that people say, like, you know, like birds of a feather flock together, or, you know, show me your closest 5 people that'll tell you who you are or where you're headed. And I think that's really true. And I think that's probably some of the worst things I've kind of surrounded myself with that kind of held me back. And I often kind of like benchmark myself with where I could have been right now had I not done certain things or been a part of certain things. And, you know, I don't like to look, it helps, you know, character development, right? But at the same time, like, I think that's something that I keep in my mind now, so that when I am kind of serving where I am, who I'm associated with and stuff like that, like, I keep that really at the forefront of my mind.
You have real lessons. Exactly. That's how I look at it.
And it keeps me from going back to that.
Exactly.
Place, you know what I mean? So it all for good reason, and it all helped me shape who I am right now. But I would say worst advice comes from just like
influence.
The influence that I was kind of surrounded by previously in my life. But
okay, dope.
I don't know if that works for an answer, but hopefully
no, that's good enough. Trust me. Let's get into it. But just before, before we get into the mortgage stuff, I want to know the lead up to becoming a mortgage agent.
You want the long story or the short story?
Whatever you feel comfortable with.
Okay, where you want me to start? How far back do you want to go?
Let's go let's start at 20.
20?
Yeah.
Damn. Okay. 20. I'm 30 now. I just turned 30 2 weeks ago.
Oh, so congrats.
Let's do. Thank you, man.
Congrats. Welcome.
Listen, I was very hesitant to get here, but now that I'm here, I'm like, all right, let's do it.
Yeah.
So let me just recap the last 10 years in a quick and dirty way. 20 years old. Finishing up college, I was in school for business. I got my diploma, graduated at Humber. I got into like the typical business type of role, wasn't really feeling it. I was like, I'm not going to be spending the next 50 years of my life working in a cubicle crunching numbers all day. It's just it's not in my best interest. I have too much personality. I have too much desire for more. And it's just wasn't really conducive to like my personality. So I was looking at other options, try to like do things a little bit differently. I worked at the bank. I did like debt consolidation. And then I was like, okay, like let's do a little bit of like YouTube, because everyone's just like, you know what, like you're really good at emphasizing the importance of money, because I've always been like the cheap person, hence the nickname, the price match poppy and all that. And like I used to like do like random stuff on my Snapchat to like just say like, okay, this is what I'm doing that's cheap today. And I was like, yo, this is funny. But like I'm actually learning as well how to kind of be more conservative about my money. So I made a YouTube channel out of it, got it monetized, took it to a good place. And then in the midst of all that, I actually got my first property, 26 years old, 27 years old. I can't remember exactly when it was. It was a pre-construction. So I put down my money. I like to tell this story because it's a little funny. So I was making a pretty good amount of money doing all the things I was doing. At the bank, and YouTube. Also I had like side hustles as well too.
Okay, cool.
So I garnered up a large amount of money by being as cheap as I had been. And I was like, I didn't know what I was gonna do with the money, but I was like, I have it. Yeah. So I went out with my friends and we were at a bar and we were like popping bottles, and like as a guy, the male bravado comes out and like someone else is like popping bottles too.
Yeah, you want to pop yours?
Yeah, you want to pop bottles. So I was popping bottles. We were going back and forth, like just trying to like outdo each other, like subtly, but like it's like a ha 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 kind of thing. So the guy comes over to me and he's like, yo, like he's drunk and he's like, yo, like you got a lot of money, eh? And I'm like, I'm doing okay. He's like, yo, like, what do you think you could do with the money you have right now? I'm like, yo, like I'll do whatever. What do you think I should do with my money right now? And he's like, yo, you should buy a house. I'm like, I'll buy a house right now. Like I'm just talking like out of my ass at this point, right? And he's like, I'm a realtor. Like I kid you not, like he completely sobers up in my face and he's like, I'm a realtor. Like, let's buy a house. I'm like, okay. And I'm like thinking, we're just here shooting the shit. Yeah. So I'm like, I'm not taking it like serious. I'm like, okay, this guy's
you're in the club.
Yeah. I'm like, you must be drunk. This must be like another phase of your drunkenness. So he takes my number and the next day I'm waking up and I get this message from this guy and he's like, here are some plans. Here's the down payment, the down payment structure. Let's pull the trigger on this. And I'm like,
bro, in less than 24 hours.
24 hours. And I'm like, that's crazy. But in my mind, I'm like, I rationalize. I'm like, why not? Yeah. Because I know I want to move out. I'm always been someone that's like, I don't want to rent because like I know what renting is. Like I'm paying down someone else's mortgage. I don't really have the freedom to like have this house the way I want it to be. So I'm like, okay, let me take this a little bit more seriously now that I'm sobered up. Let's look into this more seriously. So we have more conversations and he puts me onto this project, the pre-construction project, where it's like $25,000 down. And I'm like, I have a good portion of that right now.
Oh, that's not bad.
I'm like, exactly. I'm like, and it's spaced out over 180 days.
Oh, that's not bad at all.
Exactly. So I'm like, I have another 180 days to get the remainder. I'm like, I can do this. I'm like, okay. So now it became real to me. I'm like, this is really realistic. So I pull the trigger on it. And now I've signed on to this house and it's supposed to be closing in the following year. I'm like, perfect. I'm going to get my keys in hand the next year. Come to find out now, fast forward to that year, I get hit with the reality check that I have to get the mortgage. Cause I'm like, the mortgage comes with the house, right? Like no one told me otherwise. Why wouldn't the mortgage come with the house? So when the builder calls me like, yeah, your house is going to be closed in the next 30 days. Where's your mortgage instructions? And I'm like, what do you mean? And they're like, you don't have a mortgage? I'm like, no. Find it or you lose the house and you lose your deposit. I'm like, I'm not losing $25,000.
Wow.
Period. I don't want to lose $25. Never mind $25,000. So I had to run around like a chicken with its head cut off trying to find a mortgage. I went to my home bank, couldn't get one. I went to another bank, couldn't get one. And I had to hit up mortgage brokers to get it done. Yeah. And I got the job done, but knowing what I know now, the mortgage broker that got it done for me took advantage of me. And what I had to pay to get it done out of pocket was wild.
Yeah.
I'm not going to get into the specifics of it, but getting that all done and realizing what I had gotten myself into, I'm like, okay, you know what? Like, I don't want to have to do that again. And not only that, I don't want other people to have to deal with that as well themselves. So I was like, okay, let's look into mortgaging myself. Also, I was like, okay, do I want to live in this property? Because now I actually got the keys. So, you know, hooray, got my property. So now I have real estate. And I'm like, it was in Brantford.
Oh, okay, cool.
And this is what, 2019, I got the house.
Okay, dope.
And I'm like, do I want to live this far from where I work, which is in Brampton, which is like an hour away? Do I want to live that far from my friends and all that stuff? I'm like, it's not really practical. Plus my mortgage, I'm like, I could afford it, but I'm like, I'll be house poor. Yeah. All my money, or if not, a good portion of it will be going towards my mortgage. So I'm like, you know what, best case scenario, let me just rent this out. So I rented out the property, and I rented it out for, I can be transparent on here, right? Yeah, of course,
absolutely.
I rented it out for $2,100 for the whole house. It was a townhouse.
Okay.
And my mortgage was about $1,650.
Oh, dope.
So
yeah, that's a win.
That's a win, right? So I'm like, okay, bless.
That's cash flow too. Like,
exactly. Yeah. So I'm like, yo, I'm making about 4 bills every month.
Yeah.
Paying
off your mortgage.
Exactly. So I'm like, okay, cool. And then a year and a half later, I'm like, COVID hit. Yes. And then I'm like, okay, what's my options? Because I lost my job, and I'm like, okay, what can I really look at? I'm like, okay, I got a property. Let's see what's really going on with that. And once I saw the appreciation of it, I was like, yo, real estate is not a game. Yeah. So I was like,
what did it go up to?
So I bought the house for $365.
Yes.
And
which is good.
Exactly. Yeah. When the property was appraised in 2021, it was appraised for about $600. So I'm like, so I didn't think it was real. I'm like, this equity is mine? They're like, yeah. I'm like, they're like, either you can sell it and get the equity cash, or you can refinance.
Yeah.
So I'm like, okay, let's look at refinancing, because I don't want to lose the asset itself. So that's when I started to do my research on what are the different options with real estate. How can you best leverage the real estate once you get your hands on it? Because I don't want to sell it, come out of real estate, and then have to get back into it. So I'm like, okay, now is my time when I don't have a job. Things are relatively, like, nothing's really open. And I'm like, okay, I'm taking this time frame to really just figure out what is the best case to position myself in a career aspect, and also reposition myself from an investment standpoint, because I don't want to leave real estate realizing what I just did with it. Right. So that was where I kind of recalibrated, right? Are you good with time? I see you. Okay, cool. So, so once I did all that, I was like, okay, let's refinance, keep the property, still going to be at a decent amount of cash flow. And then I get equity out of the property as well to use towards something else. So I took that money now, and then I bought the property in Sudbury to cash flow a little bit better. And
property number two.
Okay,
makes sense.
In the midst of doing all my research, I was like, okay, what's the best ways to maximize cash flow? Because with that property in Brantford, what I didn't realize and what I got slapped in the face with was, at the end of the year, I had property taxes.
Yes.
So I had to pay like $3,000 out of pocket to pay for that property taxes. And I was like, okay, well, that really just ate up the entire $400 I was making every month. So I'm like, I didn't really make no money.
Yeah.
There's got to be a way to make more money passively, but also have the property. So I looked at multifamily properties. So basically what multifamily is basically having a property that has separate units in each within the dwelling. Okay. So a duplex would have 2 units separated, like they're not really coming into contact with each other if there's 2 people in there. Triplex is 3, fourplex is 4, and so on and so forth, right? So I was like, let me find the best place to invest that has low purchase price, can have multifamily, and also like isn't too far away. So I looked at Sudbury, and also, low purchase price, multifamily, and also will allow me to have decent rental income. So obviously when people have the idea like, okay, this property was cheap, you obviously realize that you can't demand that much in rent. Yeah. But different areas have different rent standards. So I did my research on figuring out where has the most comparable rent to Toronto, but also has not the most comparable prices to purchase. Sudbury had a pretty good margin on that. So I got the Sudbury property for about $270.
Holy, that's good.
Yeah. And I was like, that's the best way to make my money stretch. Yeah. And it was a triplex. So it's 3 units in that property.
Paying you cash flow every month.
Exactly.
How much do you charge for rent?
So I got a 2-bedroom in there. There's a 1-bedroom and another 1-bedroom. Yes. And the 2 1-bedrooms, I charge about $1,000. Okay. And then the 2-bedroom, I charge about $1,200.
Okay, so you're like seeing $3,200 every month.
Exactly. Quick maths. And then I have my mortgage. So now I'm cash flowing beautifully.
Yeah, that's
so nice. When I have property taxes and whatnot hitting me, I'm still cash flowing. You know what I mean? And not to mention the property is going to continue to appreciate in value and so on and so forth, right? And then I took the rest of my money that I had from that refinance and I put it into another pre-construction to live in over here in Brampton. So I kind of had enough money to kind of expand my investment portfolio, but also get myself a primary residence for my family that I'm trying to, have a nice little roof over our head that we own. Because like I said, I don't really believe in renting myself if I know the capabilities of owning. True. So I put my money into another pre-construction that I'm going to wait for later on in this year.
Okay. Congrats, bro.
Thank you, man. Thank you.
So you are starting generational wealth with those properties.
100%.
And you're a new father. Mm-hmm. Talk to me about that.
Listen, man, that was one of the biggest like transformative things for me, because like I said, COVID was like a game changer in terms of mindset and really figuring out what was most important. And like I said, I lost my job. My girl got pregnant. I'm like, okay, I got a responsibility on the way. I got to get I got to get my shit together. So realizing where I was and how difficult it felt to get to where I was, and also realizing it's still difficult. Mm-hmm. I'm like, yo, it would be nice to not have to go through, not struggle, but like, I wish things were a little bit easier. Your
type of struggle.
Exactly. Mm-hmm. So I was like, well, knowing I have my son on the way, I need to figure out the best way to position myself to be able to handle that responsibility financially when he gets here, and also prepping for him getting here. Supporting my family going forward once he is here, because it's not just him I got to worry about, it's my girl as well too. Mm-hmm. And then also when he gets to the ages that I was at when I was trying to find my way, I don't want him to have to do all of the things that I had to do and all the hoops that I had to jump through to make it to where I am. You know what I mean? I want to be able to give him something, make things easier for him. I saw a lot of people in my high school, in my college, and just having a lot of like luxury and sense of like not having to worry about certain things. Like I went to college, I had to juggle 2 jobs. Trust me. I had to get my car myself. I couldn't get a car passed out to me when I turned 18. Like I had to get like a lot of stuff out of the mud. You know what I mean? And I don't think that was something I don't want for my son if it doesn't have to be that way. Mm-hmm. So I really prioritize making sure that I have certain things to make things easier for him and to pass down to him when he gets to my age to really be responsible about it as well. So realizing that's why I ultimately went with refinancing the property as opposed to selling it. Mm-hmm. So that I have that property there. Now I have another property in Sudbury. Then I'm going to have another property as well in Brampton. So I have now the capability to expand.
You have options.
I have options. Mm-hmm. And then also I can give those things to him and pass them on, hard assets to him that can help him when he gets to my age or even earlier, right? Because the earlier the better. And it's just a matter of me making sure that I pass on the knowledge, right? Mm-hmm. Him not having to go in YouTube and go through all these other things that I have to do to educate myself. I'm going to be able to teach him early on so he can capitalize on it as early as possible, because I think we all can realize like the market right now in Toronto, I don't know how people are going to make it through in the next 4 or 5 years. Never mind my son in 18, right? So I want to make sure I'm setting him up for the ability to kind of have like an easier life than I had to go through.
Okay, dope, bro.
But it's just been a really good motivating factor to kind of keep myself in check and stay on my own neck. You know what I mean? Like I think a lot of the time we get complacent, and I have a daily reminder of why I got to go hard every single day and make the best decisions, not only for now, but in the future as well too. Okay. Wow. Congrats. Thank you, man.
So I'm hearing a common theme of people not actually, when they get their foot in the door, they actually don't sell their house because of, excuse me if I get their terms wrong, they don't want to pay no capital gains on it. So they'll actually keep that asset forever and then turn it to their kids or whatever.
Yeah. And that is an option as well too. Capital gains. So what capital gains tax is basically if the sale of your property, if you get hit with it, from my understanding, this is more so a tax question. Yeah. But what deterred me from a capital gains standpoint was if you sell within that first year and you take the profits, you can pay up to 50% capital gains tax on the profit. Right?
50% of your profit.
Exactly. So I'm like, imagine you walk away with 100 grand, you're giving up 50 grand. Possibly. It's not always the case. It's obviously, it's different strokes for different folks, right? It's different circumstances depending on what the property is and what your situation entails, right? But even being subjected to that period, I'm like, I don't want to run that risk. No. So I want to figure out what's the best way to retain as much of my profit and equity as possible. Mm-hmm. So I went with the refinance option because I keep the property and it's something I can pass on, and also it's cash flowing. So why would I want to give up that passive income? So capital gains can be avoided in certain different ways. Mm-hmm. So for example, in that same scenario where you sell your property, if you put the profit back into another property, you can avoid the capital gains, to my knowledge, right? Okay. So there are ways to kind of go about it. You can't just take your cash and run though. That's the thing. So you got to stay in the real estate game and snowball it. It's crazy. It's wild, but you know what I mean? Like, and I'm someone who's just like, I'm really big on, there's a lot of things that I see as problems in terms of rules, like why is this rule in place? Mm-hmm. There's no point of this. This is not really fair. Mm-hmm. But rather than complaining about it, I'm like, okay, these are the rules. Let me just act accordingly and do what's best serves me, right? Because I think a lot of people get caught up in terms of like, oh, this is not fair, and
then nothing happens, no actions are taken.
Exactly. What are you going to do about it, right? Like, can we change this? If not, play by the rules that's in place and make the best decision for yourself. So rather than complaining, I'm just like, okay, cool. Let me just make the best decision with what I know.
Yeah, facts. Okay, dope. Let's get into mortgages.
Let's do it. Sorry.
I really want to know this question. Like for the self-employed and entrepreneurs, how can we get a mortgage? What is this process towards that?
So when it comes to self-employed and entrepreneurial people, it's a little different, right? It's a little bit more tedious for you guys, for us, because I'm technically self-employed as well too, right? So you need to have your income averaged, because the way that lenders are going to be looking at your income is what's guaranteed. You know what I mean? Like, how sure is your income? So if you're someone who works for Apple, you're salaried, right? You're there, you're That's the CEO, guaranteed. You're making $200K a year. Cool. We can bank on that, give or take sicknesses and whatnot. If you're self-employed and you are someone who maybe you're a basketball trainer, right? If you break your leg, how are you going to go train basketball? You're going to have to take some time off. Your income is not going to take a hit, right? True. So there's no guarantee for your income when you're self-employed. So the problem really comes into play when you're self-employed and it's for less than 2 years, because we don't have enough of a track record to really say what you're really going to be averaging or what your take home is, right? So for someone who's maybe been self-employed for 10 years, cool. We have 10 years of records to say, okay, you made 80K as an average over this 10 years. We really look at the last 2 years. Most lenders look at the last 2 years, but just to give you an example, like they're looking at the track record basically. So if you're self-employed for less than 2 years, it's a little bit tougher. Therefore, you kind of most likely gonna have to go to the B lender space. Okay. So I know I'm throwing some words out there that are probably like, what does that mean?
So A lender is the bank and B lender is like
other people who invest in mortgages. So other companies, but they are taking on higher risk. Okay. So the A lenders are going to take the people who have, I use the words big and sexy income, right? You know, you're getting your 50K a year. It's salaried. You've been here for X amount of years. Cool. We can bank on that, right? B lenders are essentially taking on higher risk because your income is is going to fluctuate more. And for that reason, you're going to probably pay a little bit higher in interest rate. You're going to have more down payment. So to be in the B lender space, you have to have a minimum 20% down payment. Minimum.
Whee.
Yeah, exactly. So that can quickly get out of hand if you're talking about GTA properties, right?
Exactly.
So that's why I really try to encourage people like, okay, for example, I had a client the other day come to me and say, okay, well, I work here right now. It was a nice job. I don't want to say where, but they're like, I'm thinking of quitting my job, which is obviously red flag number one, because you need to have that stable income. But I'm thinking of quitting to go and pursue my own entrepreneurship.
Chill.
And I'm like, you're gonna chill for exactly. So I'm like, how about if you're looking to get a property, get that property first, get that closed, and then go explore your passions and your hobbies. Because once you quit that job and start a new self-employment gig, you start from today. Like you start from scratch. You're fresh into this world. Yeah. So let's just say now, and obviously not to mention, you're gonna have to figure out your expenses and your income for that time frame. You're gonna be starting up. You're not gonna make that much right off the bat, probably being realistic. So it's best to kind of capitalize on that guaranteed income while you still can before pivoting to that, because you don't want to wait 2 more years to have that averaged out income if you plan on being in the A space. If you do want to go to the B space, you don't have to have 2 years record, but you're gonna have to show your actual income, right? So they're gonna probably ask for 3 months of the most recent income that you've had. So you're gonna have to show
for the B lenders,
right?
Self-employed.
Exactly.
So it's only 3 months, minimum 20%.
Exactly. And you also have to pay some fees as well in there too. So there's probably like a 1% lender fee where they're like, okay, we're charging you 1% from even lending you this money to begin with.
But they're taking a risk too.
Exactly. And that's exactly how to look at it, right? I think a lot of people have this misconception like, well, the bank's taking advantage. To a degree, sure. But you have to also realize too, so the way real estate is set up, when you go and make a purchase, right? Let's just say you're purchasing a property for $500,000 and your down payment is $50,000. That $450,000 that you're going to be mortgaging is the bank fronting you that money to close your property. Exactly. And then you pay them back over the course of time. I need to make sure I'm getting my money back. Yeah, exactly. So if I'm lending you $500,000, I need to make sure you're in a position that I can trust that I'm going to get that back. Yeah. If you just quit your stable job and you're now going to be starting up an entrepreneurial gig, and let's be realistic, a lot of people start these, they don't always follow through, and they crash, and maybe they they stop
That's
after
a
a couple
long-term
years.
game.
Exactly. Not everyone has the stick-to-itiveness to kind of see it through. So from the lender standpoint, how can I really bank on you as someone who just became an entrepreneur, left their job, has no stable income to pay me back my $500,000 that I just lent you to close on this property? Right. So look at it from their perspective to a degree. And that's where it's like, I think some people don't really shift that perspective.
Yeah.
So that's how you can kind of dabble it in the B space. So if you are a new entrepreneur, yes, no, not all hope is lost. It's just, this is probably going to have to be your viable option until you get that 2 years track record to go into the A space. Okay. Because until you get to that track record, that 2 years point where you can say, okay, I made 90 grand in my first year and I made 100 grand in my second year.
Yeah.
I make 100 grand, or I made an average of 95 grand between the 2 years. Then they can be like, okay, you made an average of 95K.
Yeah.
Until you get to that point, your income is like a question mark to them, right? Because it's up in the air. We don't really have much of a track record. So that's just my piece of advice for entrepreneurs and the self-employed people watching this. You if you don't want to be in the B space and you don't want to have to, which is going to really entail putting up 20% down payment, paying maybe a 1% to 2% lender fee.
That's a chunk.
That's a big chunk because 1% of 400K is $4,000, right? That's a fee up front you got to pay.
Yeah.
So not to mention the higher interest rate that's going to be attached to that mortgage. You might want to rethink that if real estate is in your short-term goals, right? Like if that's something you want to do in the next maybe 6 months to a year, let's stick with the stable income until you finish that goal out, and then maybe shift over to entrepreneurship after you close on that. Because once you get your mortgage approved,
then you're good.
You're good. Go do what you want to go do, right? Because it's signed, it's in ink. Yeah, it is what it is, right? And that's why I tell people as well too. One thing that I see a lot of people messing up in their mortgage process, or when they're even looking for a property. I had a client do this 3 weeks ago. She bought a car. Oh no, that's new debt. You know what I mean? So it's just like, you really got to be mindful of these things because you really want to make sure you close on this house before you go get a car. You can get a car loan with terrible credit, no job, $0 down, but you can't do the same thing with a mortgage. Make sure you go secure that house first, if that's what's in your plans, and then go get your car afterwards, because you know that's the easier thing to acquire in the grand scheme of things. Okay, dope. You mentioned process. Take me through the mortgage process, and what are these lenders exactly looking for? How long does it take? I actually have no clue. So the process itself can be quick depending on the lender. So for example, TD, right? I submitted a deal to them for someone's mortgage to get closed on 3 weeks ago. Haven't heard from them yet. And that's just because they're so backed up. They're popular, as we can all tell. They haven't got around to looking at that deal yet. So if you're someone that's on a short time frame to get something done, maybe some of these A lenders are not in your best interest. But some of the other lenders that are maybe lower notoriety, they quick turnaround. Like I got someone approved for their mortgage this week. I submitted on Monday. I got the approval this today. So 2 days, they got their mortgage approved. So that's an A lender or a B lender? A lender. Oh, wow. A lender. But a lot of people have this idea like, okay, it's only the big 5 banks. Yeah. But there's a lot of A lenders that are out there that are in the same space, give actually better rates. Yeah. They're just not like your typical brick and mortar establishment. There's no tangible branch for you to go walk into, right? It's just a mortgage that's given to you. You pay them back just like you would virtually, right? So the process itself, they're going to be assessing your income, which we just talked about briefly. They're going to be looking at your debts, and they're going to be looking at your credit score and how much money are you putting into this purchase yourself, because that's going to determine the loan to the value, which is basically how much of the loan is in comparison to the actual purchase that you're making, right? So for example, if you're putting in 20% down payment, your loan to value is 80 because your mortgage loan is 80% of this purchase. The bigger that loan is the more risk on their end, right? Because that means you're putting in less money of your own. So if you want me to tier it and prioritize each of the things, number one, first and foremost, income is king. Like income is going to be the biggest driving factor in how much mortgage you can qualify for. Okay. And this is why I really stress to people, a lot of people go to realtors first to kind of get their foot in the door and start the shopping process. Well, that's why there's a pre-approval, right? Yeah. That's why you should come to the mortgage agent first, because you need to know what is in your budget, right? Yeah. We got to figure out what is it that you can actually qualify for, because the last thing you want to go do is go look for $1 million homes when you qualify for $500,000 homes, right? Because then you're wasting your time, you're wasting the realtor's time, and you're not going to qualify for this property, even if you find one you like. True. Just getting your hopes up for no reason. True. So get your pre-approval first. And what that pre-approval process is really just going to figure out where would be willing to give you a mortgage before you even find a property that's going to really take this mortgage on, right?
Okay.
So you're working backwards essentially, right? If you come to me, we say, okay, Cory, let's sit down, let's figure out what you make, right? So income is going to be king, like I said. Typically on average, you get about 4.5 to 5 times your annual income as a mortgage. That's where we start, right? So let's just say you make 100K. We're going to start at about 500K. Then we look at the second thing, which is debts. That's the quickest way to ruin what we just talked about, which is the income that's qualifying for your mortgage, right? Sorry,
not to cut you off, but what types of debt can affect your mortgage rate or process?
All of them. All of them. So there's two different ways to look at it, right? So a lot of people get this part misconstrued is they think that it's the balance. It's not typically the balance. It's more so the monthly payment associated with that balance. So I have people, for example, who have like, let's just say you drive a Benz. That was an expensive car. If you have cheap monthly payments for that car, it's not as bad. So let's just say, for example, a student loan. I had a client, we did their pre-approval the other day. So they're shopping right now. They have 80K in student loans. And that sounded really scary to them at first. And I'm like, okay, cool. Don't worry. How much are your monthly payments to the student loan? And if you have it where it's not in current repayment, so you're just like, you deferred it, then we have to count 3% of it. So that can get ugly real quick. 3% of 80K is a lot. So he has a really small monthly payment towards that balance. So we don't have to worry about it being 80K. It's just the $70 a month that he's paying towards it is what we're going to account for. So his income that he's making, we're going to say, okay, you make 100K, which is about 8K a month. $70 of that 80K of that 8K is going towards that's something else right now. So we're going to be looking at the remaining $7,930 as what you have remaining to qualify to this mortgage, right? But you can quickly see how having a lot of debts outstanding can eat away at what you can qualify with. Exactly. So for example, if you have someone who makes 100K, but you've got a big car loan in place, you've got a maxed out credit card, which we're going to be counting 3% of that balance towards as debt that you have to pay back on a monthly basis, you can quickly see how your 100K is not going to help you qualify for much. Because the statistics show, and I did my own little calculation to see how much does debt really affect you. For every $150 in monthly payments, you probably lose about $250 of mortgage.
Oh, wow.
Yeah. So you can quickly see how it eats away at that money, that qualification number that we have.
That's a lot.
Exactly. So if you have a monthly payment of, let's just say $450, that's 3 times that $250 number. That's going to be eaten away from that mortgage amount, right? So nonetheless, we're going to go from income, the debts that are going to offset that income, whatever is left over. Now we're going to look at your credit score. Credit score typically being the A space, you want to look at about 650 and up. If you're below that, don't worry, not all hope is lost. If you have like a good reason for
it's not bad. I thought it would be higher.
Exactly, you're right. And I think that's why it's good to have that conversation with me early on, right? Because let's say you want to just start your shopping process. There's a lot of ways to boost your credit score in a short period of time so that when you're ready to actually close on a property, your credit score is a little bit higher now, right? So I've actually helped a lot of clients turn around their credit score in that process while they're shopping so that now they're talking about maybe a 720 or a 730 and they're in the A space conversation again. Because if you're below that 650, now it's like, okay, it's looking kind of grim. So that's why going through this pre-approval process is a good way to kind of see where you're at right now and also maybe fix your situation so that when you're actually trying to buy a property, you're in the best position possible. So I could let you know, okay, you know what? Maybe if you go get a second job to couple with your primary income, now we're looking at that income as well. Because just for that income to be counted, you need to be a permanent employee. So you need to pass that probationary period. So let's just say you talk to me in March and we're like, okay, you know what? You say you want to get a property in July. Cool. Let's get you a part-time job right now, try and get a part-time job for April so that by the time in July, we can use that part-time job's income. Because if it's before that, we can't really use it because you're still on probation. It's not guaranteed income, right? You're not a guaranteed.
You have to pass that probation.
Exactly.
Period.
Because you know, when you're on probation, you can get cut on a whim. So that's something that I really think that people can really start to maybe formulate with how they should kind of structure their real estate endeavors, right? You don't really want to just jump into things head first like I did. A night out turned into a whole real estate purchase on a whim. If you can kind of structure it with a plan, then you can kind of approach it the best way possible.
Okay, dope. How can I determine what I can afford?
So I'm glad you asked it that way because you shouldn't determine what you can afford. You should definitely have a professional look at it because even when you're looking at your income, for example, like you said, some people who are self-employed might look at it like, okay, well, I make this much money, it's going to be realized. Not necessarily the case, right? There's going to be different stipulations and circumstances for different types of employment. And for example, I have a client that is an apprentice. And because he's an apprentice, his income is going to fluctuate because he has to go back to school at some point during the year. So even though his job letter says A, his pay stub right now says A, it's not A because, you know, at some point, maybe in September, you got to go back to school for 3 months. That's 3 months where you're not going to be working. So that income is going to be realized a little bit differently. So all that to say, you should have a professional look at the numbers for you, take in all of your situation, and then determine what your real budget is, because you can quickly maybe miscalculate things if you're doing it by yourself. Like I said, those things that I said prior with, you know, maybe 4 to 5 times in your income for the year and looking at certain things for your debt. It's just rules of thumb. They're not necessarily like concrete. Yeah. So you really want someone that's like a professional to look at these things and say, okay, this is what you're pre-approved for. I've had it looked at by this lender. You're good to go. Because if you try and do it yourself, you can quickly put your foot in your mouth and miscalculate. And then now you out buying a property and putting an offer in and getting it accepted for a property that you can't actually afford. And the last thing you want to do is be struggling to find that mortgage solution for a property that you cannot afford, because you can get sued. You lose your down payment and your deposit.
You lose the whole thing if you don't qualify.
If you go into a real estate transaction, and I've learned this firsthand because my situation was not pretty. If you go into a real estate transaction and you can't qualify for your financing, meaning your deal falls apart, right? Because like I said, if you're putting in 5% of your down payment, that other 95% needs to be covered somehow, which is by the lender. Yeah. So the seller now has taken that property off the market because
so you're wasting their time.
They're wasting their time. That's opportunity cost for them as well. Not to mention they probably have legal fees and other realtors that they had to pay for that transaction to be getting to the point where it's at. You can get sued. And not only that, you lose your deposit and you wasted your time and theirs as well, right? So it's just unnecessary on all levels. So if you can take that extra step to, you know, get your ducks in a row, it makes sense to do it, right? Because it's up no cost to you. Yeah.
Okay, dope. Are there any first-time home buyers initiatives that we can capitalize on?
There are a couple of them that come to mind. The land transfer tax rebate. So
what is that about?
So when you buy a property, when you close on a property, you have to pay land transfer tax. Your closing costs are about 1.5% of your property of the purchase price. Okay. So that's going to include your legal fees. That's going to include land transfer tax and the commissions paid to the realtor that's representing you, right? Land transfer tax, you can get half of that land transfer tax fee rebated back to you for first-time home buyers. So let's just say your land transfer tax came up to about $4,000. You can get $2,000 back after the transaction closes. It's rebated back to you at the end of the year. That's a really good incentive there. I wouldn't suggest that people try to bank on it. Yeah. Because you have to qualify for it, which means you have to have made a certain amount of income. You can't make past a certain amount of income, sorry.
So you got to be in a certain range.
Exactly. So if you make 150K, you're not going to qualify for that rebate. So I really look at people, I really try and encourage people to not chase that incentive, because if you're trying to do all of these things and jump through these hoops to save $2,000 in the grand scheme of things, that's pretty minimal. You know what I mean? Okay. Another incentive is the RRSP contribution. So if you're someone who is looking to use your RRSPs, which is your retirement savings plan, you can use up to $35,000 of it interest free as your down payment. Okay. So let's just say you've got $35,000 in RRSPs already. And now you're like, okay, cool. Like I want to go get myself a property, but I don't have anything for my down payment, or I have a little bit for my down payment. Let's just say you have $5,000. Okay. And you're like, I don't want to have to save up another bunch of money to go get into the real estate market. So you can actually borrow against your RSP early, as opposed to waiting for those funds when you're 65. And then you can put that down as your down payment. So now you have 40K because you have that 5K that you had saved up, and you have that 35K as that you're borrowing from your RSP. Yeah, makes sense. But you are required to pay that back in the next 10 to 15 years. So it's interest free.
Back to your RSP.
Put it back to your RSP. Okay, makes sense. So you're just using it a little bit early for the purpose of getting your property.
At least I like that idea, because it's kind of like your own bank.
Exactly, right? You're borrowing your money. You're borrowing your own money early. Yeah. Granted, it's in the RSP, so it is something you have to put back, and there's no interest for borrowing it. That time frame, as long as you pay it back in that 15-year window, right? So that can be really useful as well too for people who have that RSP built up. and they're like, well, I don't want to wait till I'm 65 to really reap the benefits of it. You can use it right now to get your property, right? And then pay it back over the course of time, which
I feel like we don't hear about that enough.
We don't.
Because that's literally using your RSP as your own bank.
Exactly. So it's a game changer.
Smart.
It's just, if you have that resource there, I urge people to really utilize it, because what other purpose is it serving right now?
Yeah, exactly. And
you know
I don't
what I mean?
Wait till I'm
65.
Yeah.
You know what I mean? So I'm like, use it. That's something that I really urge people to use to their benefit. The last incentive I'm going to talk about isn't really the greatest in my opinion. It's one that was like, I feel like it was a vote ploy when the last election was taking place.
Okay.
Where it was like government assistance to get yourself a property, where they're like, okay, well, we'll match your down payment to get the property. It's not a gift. So you're actually required to pay that percentage back when you sell your property. So it's really like a joint venture with the government. So let's say you have 5% down payment, the government
5.
Another 5, so you have 10, right? So you still have to qualify for that 90% of the mortgage.
Yes. Because
that 90% loan to value is going to be the difference, right? And when you have your property now, if you're going to be selling it, you have to pay back the 5% of the equity,
sell price.
Not the 5% you borrowed. The 5% of the equity.
What it appreciated too.
Exactly.
So that's how they make their money.
Exactly. So that's why I'm like, it's not a gift, because I got to pay back, what the profit would have been.
Yeah.
So it's more so a joint venture in that regard.
But that's still not bad.
It's still not bad.
That's like,
it gets you into the market.
Exactly.
Yeah. But it's just like, I think the way they worded it when they really proposed
it looked like it was a free gift.
It looked like it was a grant, and it's not a grant. It's a joint venture. So that's another incentive that's there for you as well. That's an initiative that you can look into. But it is tough to qualify for it, because remember, now that you're getting that gifted that gifted down payment to help you get into the market, you still have to qualify for the mortgage, right? So you're going to be getting the assistance of the government to get for your down payment, but you still have to qualify for the mortgage with your income and your situation, right? So,
and you already need the assistance, so it's going to be a little harder.
Exactly.
No matter what. Exactly.
So I've only seen it successfully used a handful of times, but if you can make it work for you, go ahead. But just based on how difficult it is to actually make it work, I wouldn't suggest that to be something that people bank on.
Okay, dope. So a couple terms that I'm hearing, and I actually don't know the meaning to any of them.
For sure, let me clear it up.
To a T. Fixed rates, variable rates.
Okay.
Pros and cons to both.
So me personally, I'm a variable rate guy. I'm not gonna lie. I'm a variable rate guy.
That's where it fluctuates.
That's one where it fluctuates, right? So what the variable rate is like there's a prime rate, which is what I think a lot of people heard the other day, which is like Bank of Canada is increasing their rate.
Yes.
So that's going to have a direct implication on what is going to happen to the mortgage rates with people who have mortgages, right? So there's a prime plus or minus what the bank is going to be issuing out to you.
Prime
and
plus
or minus like 1% is what you'll probably hear.
Okay.
So like people who have line of credit are probably familiar with this as well too, because their line of credit is probably like prime plus 2.8 or something like that. So that prime is going to fluctuate. The rate that you have can probably fluctuate as well too. And as it fluctuates, your mortgage payments are going to fluctuate as well too.
When you're variable.
Okay. But it's relatively small fluctuation.
Yeah.
So it's usually by like 0.25%. Which can change your payment. Don't get me wrong. It's not like that can't be detrimental. That can be a jump of some sort if your mortgage is high, but it's small in the grand scheme of things. And I'm going to say why when I explain fixed. So fixed rate mortgages is pretty straightforward. It's a fixed rate that's going to be making your payments the same every month, right? Because that interest is not going to fluctuate, meaning your payments are not going to fluctuate, meaning you pay the same amount every month for that 5-year term. The reason why I'm team variable is because of the cons. So the con for a fixed rate mortgage is when you break it, the penalty is relatively massive because there's an interest rate.
Breaking it by like missing a payment or?
No, breaking it in the terms of like if you sell your property, if you refinance.
Oh, before 5 years.
Before that 5-year mark, right?
Ooh.
Because they charge you the interest rate differential. So what that means is they're going to be charging you the interest that they would have made had you not broken that mortgage. And had they give that money to someone else in the form of a mortgage, right?
Okay,
so that can quickly get to a big number.
Get ugly,
And so the earlier you break it, the uglier it is because that's a lot more time that they could have made more money in interest. So to give you guys context, to do my refinance a year and a half after I get my property, my penalty for breaking the initial mortgage was $15,000.
Oof.
Granted, it came out of the money that I was getting from the refinance, but still losing $15,000, that's money that I could have had. You know what I mean? Whereas variable rate mortgage, the penalty is 3 months simple interest. So every mortgage payment is principal and interest.
Okay.
You're paying, some of that payment is going to go towards the principal, which is the loan itself, which is your mortgage. And the other portion is going to be interest that the bank is making as, you know, the benefit, the profit to giving you that mortgage. You're going to get charged 3 months of that. So if your mortgage is, let's just say $1,500 a month in total, and the interest on those payments would have been $1,000. Yeah. It's $3,000 because it would have been 3 months.
To 15 on the fix.
Exactly. And looking at statistics, and I guess people can kind of do their own self-reflection as well too. Most people don't stay in that same property for the duration of that 5 years. A lot of people break that mortgage early because, you know, circumstances change, family grows. Maybe you got a new promotion. You want to go get a bigger house. You got a lot of appreciation. You want to go sell and move somewhere else. Yeah. A lot of things can take place. Most people do not see that whole 5 year term out. So the likelihood of you breaking that mortgage is probably a little bit higher depending on your situation. And that's something that you should probably take into consideration, right? Not to mention, variable rates are about 1.5% cheaper than fixed rates as of right now. So you're already getting savings right off the bat. So even if that variable rate does creep up, if it takes 4 years for it to match the same thing as that fixed is right now, that's 4 years of savings already as is, right? So if you're just looking at it in the sense like, okay, let's just use me and you as an example. Yeah. Because I think once people take the bank out of it and they use people as examples to kind of gauge it, it makes more sense, right? So if I'm like, okay, Cory, I give you $100. Yeah. And you're going to pay me back over the next year. I'm going to use a shorter time frame even too. And you could pay me back in payments of $2. Okay. Or you can pay me back in payments of $5. Would you rather go for the $2 or $5?
Right. Well, off the jump, I would do 2, but unless I know.
But then let's just say halfway through the year, I'm like, okay, it could raise up to $3. It's a possibility. You're going to be like, oh, that's scary. Like, what if it goes past 5?
5, exactly.
But what's the likelihood of it passing 5?
I don't know.
Because the rate only increases by about 0.25 every time it goes up. So it would take 6 hikes for it to get
that's true. True.
1.5%, right? Okay. So looking at the statistics of things like variable rate, and this is a true fact. Yeah. The past 40 years, for the variable rate has been better than the fixed rate. 38 years out of that 40.
Okay. So if you know your history, then you can gauge a better decision.
Exactly. But the rates, just knowing how high it can jump, like let's just say I'm giving you a 1.5% right now. Yeah. And the fix is 3 right now. Yeah. That's a 1.5% difference. But the rate only increases by 0.25 every like 4 months. It would take 6 whole hikes at 4 months apiece to get to match what it's at fixed, right?
I'll take that chance.
Exactly. Yeah. And also knowing you might even be moving in that 5 year time span anyways. So what's really the risk that you're running? But I do understand as well, some people like stability. I'm not opposed to it at all. Yeah. I'm not someone that's saying, okay,
situational.
Exactly. Guess, Everyone has their own preference. So, and that's also too, like if you're maybe you're in an older demographic, maybe you're settled already, you're not having any more kids, you like where you're buying your house, this is where you plan to kind of retire and hang it all up. Go for fixed. Go ahead. You know what I mean? Like if that stability gives you peace of mind, because I think peace of mind is priceless when it comes to these things. But for me, as someone who wants to make sure I'm saving as much as possible, and I'm also going to be pivoting a lot in terms of my investments as well too. Yeah. Variable all day. Yeah. Because I know I'm making that savings every month compared to what I would have had to pay if I went with fixed right away. And also when I plan to pivot and I want to sell or I want to refinance, which I plan to do because I want to extract the equity out of that home instead of leaving it dead in the house, that penalty is going to be minimal.
Okay, dope. I want to talk about credit history because when I was in my younger 20s, I messed up my credit.
We all did.
Yeah, so we all did. I want to know, how far does it go back?
You want the truth?
I want the truth.
So it can go back as far as 7 years.
Oh shit.
Yeah. So granted, you know what I mean? Like we're gonna be reasonable. We're not gonna base the decision itself on the 7th year ago, right? Yeah. It's going to be based on what you have going on right now. Like, and that's why we're looking at your income and your debts right now, not looking at, okay, did you max out your credit card when you were 23? Yeah. Okay. But that's going to be visible to the lenders, right? Some things that would be glaring from 7 years ago is like, okay, did you have a bankruptcy 7 years ago? Did you have like a consumer proposal? So really detrimental things can be looked at, but as far as what can be seen is going to go up to about 7 years ago. And that's going to include also things going to collections. So you really want to make sure you're being as responsible as possible when it comes to your credit, because you don't want things that were like eons ago to come and ruin what you got going on right now, right? Because what your credit score is really just a depiction of your character. And that's what lenders are really gonna have to go off of, right? It's gonna tell a story. It's gonna be like, okay, well, looking at Cory, what does Cory's score and his credit bureau actually show about him, right? Yeah. So that's something that you really want to be mindful of. And that's why I tell people, like, don't really loaf on getting your credit situation in order, because the quicker you get it in order, the further back they can go where your situation was cleaner, basically, right? So, and not to mention it improves your credit score, right? So make sure you're on top of those credit card payments. Make sure you're keeping your balances low. The biggest things about credit are the 5 things about credit. The 5 pillars are, your your payment history, which is paying back things on time. Your utilization, which is how high your balance is compared to the actual limit you have overall. I heard
you shouldn't go over 30%.
That's where you'd like to stay. Yeah. It's really the red zone where you wouldn't want to pass is about 70%. Okay. So as long as if your balance is 10K, try and keep it below 7K. Okay. And also keeping your payments on time as well too, right? So utilization, you don't want to go past 70. 30 and below is like, okay, this person's managing it well. Okay. In between is like, okay, they're going to look at other things to kind of really determine what your character is really saying. Other than that, it's going to be your inquiries. So how much are you really demanding out of credit? Other than that, it's going to be credit history as well. So that's going to be, how far back does your credit actually date back to? So those are the things that are really going to determine your credit score. And being on top of those things is really what's going to determine your score and how lenders look at you as well too.
Okay, dope. So when it comes to joint ventures, let's say like my credit's all messed up and I want to partner with Damien to get a house, right? Or something like that. How does that process work, and what do they look at in terms of joint ventures and stuff like that?
So any situation when it comes to getting your mortgage, it's going to be, they're going to look at both of you, right? Okay. It's good. It's a package deal. Okay. And this can be obviously to your benefit or to your detriment. And in a situation like this, where I stress to people like, yo, do a joint venture. Like I'm pro joint venture, because looking at the market at how it is right now, it's tough to do things by yourself. Like Facts. I said, even just doing the example with just like the cut and dry numbers with income on 100K by yourself, you're not qualifying for that much.
Yeah. Especially if you're doing B lenders too, with 20%.
Exactly. Right. So if you can combine your situations together, it makes it a lot easier to kind of salvage, right? So let's just say we take that same example where you made 100K, and let's say Damien makes another 100K. Now you got 200K between the two of you guys. If we're using that same 5 times rule, now you're looking at $1 million in mortgage, right? Jeez. If you guys are debt free and everything else pans out. For sure. But like, you can quickly see how having 2 incomes as opposed to 1 is hugely beneficial. Yes. In the case of credit, let's just say your credit's not the greatest. If someone else is on that application with you who has good credit, then it can kind of make up for your exactly. It can kind of make up for your shortcomings, right? Okay. So that's why I really I promote, and I'm a big proponent of joint ventures, because 2 heads are always better than 1. So not only from an income standpoint, but also from a credit standpoint, and also from a down payment and money standpoint, right? Like if you've got 40K and the person that I got 40K, we've got 80K together. We qualify for a bigger mortgage together. Now we can get into the market and capitalize off the appreciation and do whatever else that we have to do. We have more capital to tap into. Maybe you've got a line of credit, I've got a line of credit. We can do some renovations together. Now we have a project on our hands. We lift this property to a higher value. We sell it. We do a flip essentially. Okay. Now we go and make 100K in profit. We split it 50-50. Jeez. And then you also walk away with the money that you put into it as well to start off with. Now, maybe you have the 50K that we came into it with. We just split 100K down the middle. Now we both have 100K individually. Now we can go do this by ourselves. Yeah. You know what I mean?
Or you can keep doing that.
Keep doing it together. You know what I mean? So I think it can quickly show you the opportunity that's there between joint ventures, because you two together can now get into a different market that's maybe more affordable, as opposed to having to go out somewhere pretty far like I had to do in Sudbury because I did it by myself, right? Okay. So joint ventures can be really beneficial. And I know a lot of people get kind of squirmish when it comes to like doing something with other people with maybe like it's not even family, right? Because you're like, oh, how can I trust I'm going to get my money? There's contracts in place, right? You do the proper legal, you go through the proper legal channels. You can ensure that, there's no undercutting going to be going on, because it's in writing. Like I'm a 50% owner, you're a 50% owner. Cool. This is a joint venture. It's in paper, right? So you can't really snake me in that regard. Okay.
Cause I was just going to ask you that. I was just going to ask, like, how can the Black community be more comfortable with joint ventures? Because I feel like, the Asians and the brown community, that's their thing.
Listen, man,
we need to start doing that.
I agree. And I don't think people realize like how deep it really goes. And that's what's really that's not only what created the wealth gap that we're kind of seeing right now, but that's also what's making it even bigger as we go along. I heard
we're like 180 years behind.
Bro, I wouldn't even be surprised if that was like you underestimating the number. Like that was it being shortchanged.
Yeah.
So I see a lot of other people kind of putting their resources together where I'm seeing like even all 4 or 5 people on a mortgage application.
Really?
Yeah, because they realize that they have more power together than separately. So what they'll do is sometimes I'm seeing people like, okay, like in that same scenario where there's like 4 or 5 people, they get a house that's now they can qualify for a bigger house.
Yeah.
There's probably 4 or 5 bedrooms in that house. Everyone has a room, and then they're all banking on that equity that's gonna be growing on in that property, right? You're splitting the mortgage 4 or 5 ways.
Oh, that's easy.
Everyone can come together with like 6 bills.
Yeah,
you know what I mean? And then that property is skyrocketing in value. They turn around and sell it. Everyone splits it 5 ways. Yeah. Everyone has enough now to go and do their own thing with their own family, right? And it's just short-term sacrifice for long-term gain, and that's really what it is. And I think us as a community, we can really benefit just by having these conversations a little bit more openly, which is why I'm glad that you're having this podcast and talking about these things, because I think that that's really where it begins. I know a lot of people, like, for example, like my friend group, we really just started getting more comfortable discussing like, okay, how much do you make?
Numbers.
Exactly. You know, the things that we would really be like,
it used to be so like there's like a
taboo. Exactly. Like even to this day, my mom does not share to me how much she makes, which is cool. Like it's your business, but like
we should be more open with that.
We should be more open about it, because that's where the opportunities can really come together to do certain things together that would benefit the both of us, right?
Yes.
But I think having those transparent conversations and really exploring these things together instead of trying to just like, okay, well, I'm keeping it to myself. Like I'm gonna do this on my own, as opposed to, okay, let's work together. Let's build a strong foundation together, and then we can kind of do things on our own later on, if that's even what we want to do, because we can quickly see the power we have together as opposed to individually. So also not having those transparent conversations stops us from learning faster.
Yes.
So I remember like when I went through my whole debacle of trying to get my property, I shared it with my friends and like, yo, I didn't even know that myself. And now my friends who got their properties after me, they didn't have to go through that. Yes, I had to be the guinea pig, but like, I'm glad to know that other people were able to learn something from my mistakes and gain more clarity and knowledge on a situation to better maneuver themselves.
100%. Because
that's where it starts. If I had someone who was clear and open about their own experience beforehand, before I got into mine, I wouldn't have even made that mistake to begin with.
Exactly.
So the reason I was able to make that mistake is because I was in the dark already based off other people being private and not really sharing information themselves. So
we got to break that stigma.
We got to break that cycle, man. And I think it starts with podcasts like this and just having those open conversations and making things
and discussing numbers.
Exactly. Cause what's the shame in it? You know what I mean? And I think it all depends on, it all goes back to perspective, because I have a friend who told me how much they made last year, and it was a lot more than I made last year.
Yeah.
And I was like, I'm inspired. You know what I mean?
Yeah.
As opposed to someone like, bro, this guy made that much money. I'm cheese. Like, I don't want to talk to this guy. You know what I mean? Like, it all just goes down to what kind of mindset do you have? Like, if you're open to it and you can utilize it in a positive way and make it beneficial to you and inspiring and motivate you, go. I'm all for it. So that's why, like, I really try to have my platform as transparent as possible to show people that things are possible and also help them kind of expand their mind and look at things from a different perspective to better inspire them to do things better than I did it. You know what I mean? Absolutely. And not only realizing that it's possible to begin with.
Absolutely. I also feel like a realistic situation, like let's say like the 23-year-old that maybe only has maybe 15K and 5 friends have 15K and they all still living at home. They can still get an investment property at 23.
Exactly. And like you said, right? Like if it's 3 friends and they all got 15K a pop, that's 45K. And then also all of their incomes combined, even if they make 30K each, right? They all make minimum wage. That's 90K together. You guys can qualify for something that would work great with that 45K. You know what I mean? So pooling your resources can be really impactful in a good way. It's just a matter of having that conversation and being open to it and realizing that that's an option, right? So I think that that's something that I would strongly encourage people to do and look into, because it's not getting any easier on your own, never mind as a group, right? So the quicker you can get into that market and make that move, the better.
Okay, dope. And I want to talk about your personal
sorry, one second. I just want to add to that as well too. So joint ventures don't have to necessarily mean as well too that we're all coming with the same resources, right? Like I don't have to have 15K, you don't have to have 15K. It can be different as long as we have that agreement, right? Because you can't get into the market by yourself.
Yeah.
Because you don't have a job right now.
Yeah.
I can't get into the market myself right now either because I don't have no down payment.
Yeah.
So let's pool our resources together, get into this market together, split the profit, or figure it out, whatever makes sense to you guys, right? Like maybe you value the money and you think it's not a fair split. Cool, go 60-40.
Yeah.
Go 70-30. But figure out what works for you,
but because it can work.
Because staying on that sideline and staying out all together is doing nobody any benefit, right? It's doing you guys both a disservice.
Jeez, so that actually just opened up my mind a lot.
Yo, I'm listening.
That opened up my mind a lot.
I don't want to say nothing crazy on here, but like I know a lot of people that make a lot of money in certain ways that they can't really get into a certain position because of that, right?
Yeah.
If you know you have the money and you know someone else, okay, like you can qualify for a mortgage because you fit into this lender space.
Let's make the deal.
Let's make it work, right? Yeah. Because what else are you gonna do with that money? You're gonna sit there and let it not. You're going to lose money over inflation alone. The market's getting even crazier. When are you going to actually get into the market?
Yeah.
Sitting there and doing nothing is the most expensive thing you could do.
Cash is trash.
Yes, exactly. Put that into hard assets, whether it be crypto, real estate, whatever. You got to do something with your money because working for your money is not doing anything for you these days. Absolutely. Inflation is at like 4%, 5%. You having your money on hand is detrimental. Putting it in the bank, you're losing money. Yeah. So you got to figure out ways to be creative and put that money to work because the quicker you can make your money work for you is the quicker you can find financial freedom.
Okay. Shit. Dope. That's a gem I needed. I can't even lie to you. What's next with real estate for you?
Man, listen, I got big a lot. I got goals. Very big goals, man. I think I'm a very big proponent of having big goals.
Yes.
Because I feel like you really want to make them almost like unbelievable. Because if I'm striving to do something that's like unbelievable, even if I don't achieve that,
you're gonna have I'm
in a good place still. So my goals for right now, like I said, I got that triplex in Sudbury. I'm actually doing renovations on it.
Okay.
So this is more so about real estate investing strategy. So this is a BRRRR. So what a BRRRR is basically you buy a property that's undervalued, you renovate it, so you increase the value of it, you rent it out to people at the higher value now, and then you refinance so that you take some capital out of that property, and then you can repeat it all over again because I essentially got my money back. So that's what I was doing with this property in Sudbury. I'm almost done.
That's the 3-door one, right?
That's the the 3-unit property. So I'm renovating the last unit right now. So once it's done, I should have that value. I think I told you guys I bought it for about $270. After the renovations are done, the value should be about $390.
Oh, okay.
So when I refinance it now, I'll get a good portion of that money I put into the property to begin with out,
back.
and then I'm gonna go with another property.
Okay.
But then I'll still have that property to me, cash flowing.
Yes.
Not to mention I got the other property that I still have in Brantford, and then I got the property I'm looking to close on in Brampton to live in. So that's not an investment, but that's just going to add to everything. At the end of April, my goal is to refinance, get the cash out of that property and probably go put into 2 more, if not 1. And then like I just keep expanding my portfolio from there because my goal is to completely replace my income through real estate. Oh, exactly. Okay. So passively, so that anything I do make from my active job, which is being a mortgage agent, I love doing what I do, but if I can have more time to myself to spend with my family, which is my main priority, that's what I want to do. And then anything that I make in mortgages as a broker is additional, right? That's not money that I need on a day-to-day basis to really satisfy my expenses. But I'm looking to kind of just expand my portfolio tremendously. My goal in the next 2 years is to have 8 properties.
Okay.
That's my goal.
And you have 2
properties, 3 units. So I want to have 8 properties.
And it's on camera.
Let's get it. Now I gotta show and prove. So listen, end of 2023, we're gonna have we have to revisit this and see where I'm at with things.
Okay, dope. Have you ever thought about like public speaking about the mortgage space or real estate space?
So I do have my Cognitive Capital podcast where we do like to kind of shed light on the real estate space and the mortgage space and real estate overall. I do have my YouTube channel as well, Who's Fly TV, where I document my real estate journey as well and talk about other things with financial literacy that are outside of real estate. So how to budget, how to best maneuver yourself financially, because there's a lot of things, even basics before you even get into the real estate space that I don't think people are aware of. So my goal is to really just have people as financially aware as possible.
Yes.
So public speaking specifically, I haven't really thought about it, but I'm open to it.
I think you think so? There's a lot of money in it too.
I don't like money to be my main driving factor, but a nice little checking. I'm not mad at it. So I might look into that for sure. That's something I might put on my list as well too. I do want to be able to have like a fund where I want to be like a private lender. But
how does that work?
So private lending, is another way to kind of invest in real estate more passively. So what I'd be doing is lending out money to individuals who need it. I'd put
what type of money are we talking about? Like
it can range, right? So I've seen people lend money in a small amount. So basically they put it into like a fund. So like if you have like $5,000 you're not using for the next 6 months, put it with somebody else who doesn't have any use for their $5,000 for the next 6 months. Someone will collect it and go do whatever they're doing with it and pay you guys out.
Oh, okay.
Over the course of that 6 months, right?
Okay.
But then there's also people who just do it themselves on a bigger scale where it's like, okay, they lend out $100,000. You go do whatever you're going to be doing with it, right? Like let's say you need it for renovations.
Okay.
And I charge you 10% interest on it. You pay me back when you're done with your project.
And you have a time frame.
You have about 12 months or, you know, it's usually 12 months.
That's
maybe you can do 6 months.
I like that.
It's a good way to make your money snowball it passively, right? Because I just give you the money, you do what you're going to do with it. And if you don't pay me back, there's a lien on your house, right?
Ooh.
So I got enough security to make sure that I get my money back.
How do you get into that space? Like, for example, like if I wanted to do that tomorrow, who am I calling?
Me.
Okay.
Because as a mortgage broker, right? Like, so and I want to clarify this as well too. So what a mortgage broker is someone who will work in the best interest for the person who's trying to get the mortgage and exhaust all options and channels to make sure you get the best product for what it is that you're trying to do. So I have access to A lenders, which is like, you know, your big 5 banks, your RBCs, your Scotias, your TDs, other A lenders that I mentioned to you as well that are in that same space that have similar rates. And then we got B lender space as well too. And you say, okay, you know, I'm trying to do this property. This is my goal. This is my plan for it. This is my investment property. I'm going to plan to have it for like a year. Okay, cool. Well, we don't have to go to this A lender. We can go to the B lender space because they have these slightly higher rates, but they don't charge you a penalty when you break it.
Okay.
You know what I mean? So I find you the best product amongst all of the options because most people think they have to go to their home branch. They go to their one bank that they bank with for 20 years.
Okay.
They might not even qualify you, right? So taking your situation, what you're trying to do, I find the best solution for you amongst all the different opportunities and resources that I have.
So you're like the plug.
I'm the plug.
To the cartel.
Exactly. I won't say the cartel, but if the cartel's watching, I can be the plug as well. But yeah, like, so and let's just say whatever you're doing in real estate, let's say you need some private funds. So it's not about a mortgage, it's not about B lender or A lender. You need some private funds for your renovations that you're going to be doing.
I didn't even know that. You can do that.
I have someone who has that $100K that they're not using that I could say, okay, you know what? Cory here has this plan in place. He's got, this is the situation. This is how much he makes. This is the property he's trying to do it on. Good deal to you. Yes or no? They're like, yeah, cool. They'll wire you the funds by like the end of the week.
Wow. Yeah. And you can pool those funds
together to do whatever you're trying to do.
So let's
right?
say like
as long as it works, right? As long as the deal makes sense to the person who's lending it out, right? Because let's say you have this, let's say this is your first property.
Yeah.
And you're like, well, this property is $300,000, but it's probably going to be like worth like $320 when I'm done. It probably won't make sense, right? Because how is the person that's going to be lending you money going to make their money if you're making only 20 grand? And I'm charging you, let's just say $5,000 to lend the money to begin with, right? So as long as your deal makes sense and how you explain it makes sense, you have the capacity to carry the carrying costs of borrowing that money and the mortgage itself too, they can say yay or nay to it.
Okay, cool.
Yeah.
So let's say like I have 20 grand to lend, right? And someone comes to you, then they need like 100. Like, are you finding the rest of that 80, or like, do I have to come with a partner, or how does that work?
So I could utilize you. Let's just say, because remember, it's not just you, right? So it'll be, let's just say it's you, Damien, and 3 other people who have 20K. What if I just pool all 5 of you guys to get that 100K to that person? So I'll say, okay, Cory, swing this 20 to this person. You tell me what your interest rate that you want to put on it is, what the lender fee you want to put on it. You dictate. You're the bank in this situation.
Wow. Okay.
So that's where I think it can be powerful, because you really get to dictate the rules that the person that's borrowing it plays by. And you can also say no, because you're like, I don't like this plan. I'm not really, I'm not touching it. You know what I mean?
And then you possibly get a lien on their house, and
the lien is going to be there
regardless
as a security, because let's say the person that borrows the money, they get into a sticky situation. They're trying to ghost you.
Okay.
Cool. You can ghost me, but you can't. This property is, I'm on title is what that means, right? Because it'll be the person that owns the property. It'll be the place that has the mortgage for the first mortgage. And then you'd be in position right beneath it to get whatever's left over after that property is sold, right? So that's what a lien is.
Okay.
The property would be dissolved, aka sold. And the funds would be dispersed accordingly to who is owed what. So you offered, you let someone borrow 100K or 20K, you're in line to get your 20K plus whatever interest that your contract said, right? So there's that lien as security. And not to mention you can sue now, because you put me in an uncomfortable situation, right? So there's a lot of power there. And also, like, it's just more comfortable. You know what I mean? Like you're
more
just
options too.
I have the people that I have access to with private funds.
Yeah.
They're literally people that's like on vacation. They're like, yeah, cool. You need money? I'm gonna just wire it. Like they're just on vacation all the time because they've got the money just ready to lend out. And that's how they make their money. Right. Yeah. So imagine you have 100K out in circulation and you're making $8,000 on it a month. That's your income. You know what I mean? Depending on what you're charging in terms of interest, right? So that's what I want to get to initially at some point.
Yeah.
But what I want to do, and I want to kind of put a little bit of a spin on it, I really want to help people.
Okay.
So I want to get to a point where I have enough capital that I'm not actively using.
Okay.
To lend out to people who need it, but not as such aggressive rates. Because this private lending that we're talking about right now, the rates are not pretty.
Yeah.
You're looking at like maybe 9% bare minimum.
Jeez.
And that can be pretty crazy when you're talking about bigger numbers, right? So I want to be able to lend out that money to help people get their foot in the door.
How could you secure yourself by bringing down your rate?
That's the tough part, right? Because I don't want to have to like put myself at risk to benefit other people. So that's the difficult part, right? But I guess it would come down to a point where it's like, okay, let's just say you're a first time home buyer. I really want to help you out. You need some money to kind of use as your down payment to even acquire the property. Cool. Well, how about I'm just doing joint ventures then? So like I'd be like a 3% owner in this properity. So that if worst case scenario, we have to sell this property because you're falling behind and you're defaulting on your payments, I still get back what I put into this and then some to make it worth my while. But I still helped you as well too, right? Because I think a lot of people are in this situation right now where it's tough to save up money right now in this economy. Prices are going crazy. It's like if you're not already in, it's looking really grim in terms of how to get into that market. So I want to be like a resource that people can kind of look to help them get into that market when I think it would be like no other option is really going to be there for them. So they can still have the benefits of home ownership because I've seen how it's changed my life and I want to be able to see other people do the same thing for themselves as well too.
I'm looking forward to that.
I hope so. That's the long-term goal because you need to have a lot of money on hand that I can't be actively looking to use, right? Because in the private lending space, if I lend you that $50,000 and I need it now because my pockets got tight,
you can't get it.
That wasn't a part of the agreement. Yeah. So I got to make sure I'm self-sufficient enough to not rely on that money that I lent out.
Okay.
So yeah, that's the goal in the long term. Hopefully I get there. I will get there. We'll just see when.
Okay, dope. Yeah. So I'm not exactly sure how it works in Canada, but you always hear like deals in the States like foreclosure for dirt cheap. How is that a thing here or like how does that work?
Man, honestly, that's a sticky game. Foreclosures happen everywhere.
Yeah, okay.
It's pretty much people defaulting on their mortgage insurance and then the house gets repossessed by the bank. In most cases though, here in Canada, the property will just be sold.
Okay.
So that's why they ensure.
There's no special list.
I haven't seen it if there is, but most cases it'll be like if there is gonna be a list in that scenario, I think you're thinking about an auction.
Okay.
So and that's what happens more so in the States. There's like an open auction. So houses that have been repossessed, they'll go to an auction and whoever the highest bidder is, cool, sold to that person for that amount, right? So that's where like people can get really crazy steals in the States. I haven't seen it so much over here, but it is something that I want to look into as well too, because you could be looking at some pretty good deals, but it's just like most cases the houses are run down. The house wasn't really well treated. It was in a bad area anyways to begin with. That, and I don't mean bad area like Jennifer. I mean like it's like it's like Sarnia or something like that, right? So it's just like
not really worth it.
Exactly. It might not always be in your best interest to even go acquire a property like that because it's just like, well, what am I going to do with it? Yeah. So it's a good way to, if you have the patience and you really want to do your research and look constantly, maybe you can find the gem and the diamond in the rough here and there. But for the most part, it's not an easy game to get into still.
All right, dope. Yeah. Is there anything that I'm missing about mortgages? We went over the variable rates, credits, debt.
Yeah, that is the biggest thing. I think what people should really look to kind of make sure that they're on top of right now before getting into the real estate space is just minimizing and reducing as much debt as possible, because that could be the biggest thing in terms of not just a qualification standpoint, but also getting into home ownership is no joke. You have your mortgage to worry about. You've got property taxes to worry about. You might have condo fees in addition to home insurance, not to mention all the other expenses that you're gonna have outstanding as well too. So someone like me, I really prioritized making sure I had no other debt in place before getting the next property, because I was like, I don't want
no new car.
No new car. And that was the biggest thing for me from an investment standpoint, because I'm like, let me delay that gratification. I know I want a new car. Like I said, I got the property. I got the property refinanced. So I got some cash on hand, and I was like, okay, where are we going to first? Or are we going to ball out? And I was like, you know what?
Let me chill out.
Because I've seen a lot of people not be able to re-enter the market.
Wow.
Because they took out their money. They got a nice payout, but then the prices kept climbing. and
they couldn't get back in.
So I was like, okay, I got this money right now, although I can go buy a car and I plan to buy it outright. Let me go get another property.
Yeah.
Because I know I really prioritize that extra cash flow I'm getting every month and the asset. And then also I can refinance that property in the future to get more cash out to go do it all over again. So that's something I really want people to kind of prioritize first and foremost. I see people come to me all the time saying, okay, let me see what my pre-approval is saying. And I look at the numbers and I look at their whole portfolio and their profile. And I'm like, you got to get some of these debts down because you're not going to qualify for much. Even though you make a good amount of money, you spend a good amount of money on the debts that you have outstanding. So you can quickly lose your leeway in the mortgage space, which your mortgage is everything because you're not buying that cash outright. I mean, you're not buying that house outright, straight cash, right? So you're going to have to mortgage something on that property. You want to make sure that you're maximizing your dollar. So keeping your debts in check is essential.
All right, bro. One question that I ask everybody, where do you see yourself in 5 years? I want to make a prediction. I want to play this back.
5 years?
5 years.
I'm 35?
Yeah.
All right. So first and foremost, I'm living in a detached home.
Okay.
That's first and foremost. I need a backyard.
Yeah.
And I don't want people attached to me. I don't know why. I'm just like, I don't know how wild I plan to live in my life, but I'm like, I want to blare my music. I don't want to hear nobody complaining about it. So that's first and foremost. I want to have a portfolio of rental properties alone.
Yeah.
5 years.
5
years.
35. I heard your 2 year.
2 years. I said 8. Okay. I'm not going to times 8 by I'm not going to double it exactly because I do plan to kind of veer away from real estate after a certain point.
Okay.
Like I want to get into that private private lending space. So I'm going to say 15 properties in 5 years. 15.
All right, let's get it.
I'm saying it right in the camera. 15 properties in 5 years.
All right.
And I want to be financially free. And that means not necessarily not doing mortgages anymore and not being a mortgage agent, but that means not having to rely on the income I get as a mortgage agent because I want the passive income I get to be able to fund my lifestyle.
Okay.
So that's my goal.
Wait. What about kids? Any more coming? What's up?
Listen, Carter, you're giving me a run for my money at this point. I don't know if you're gonna get any siblings right now, but if we do, I want to max out at 2. I really wanted a girl. I want to be a girl dad. Yeah.
Cool.
So different. Maybe he got a little sister on the way. We'll see.
Yeah.
And obviously have my nice little bride. The ring will be coming soon.
All right,
and I think that's where you can see myself. I want that YouTube to be at 100K subscribers.
What are you at now?
2,000. Okay. So I gotta 50x that. Yeah. Okay, cool. So we'll get there, but that's the plan. And then, like I said, having that private fund to kind of help people get into real estate themselves. And I do want to look into, and this is like something I had like a little bit of it's a plan in my background or my mind. I really want to be able to mentor people.
Yes.
Because I have a lot of people reaching out to me on a regular basis asking me, okay, like how can I get into real estate? What's the best thing I should do? How can I do what you did? And I'm like, I want to share that. That's why I have the YouTube channel. That's why I have the podcast. Yeah. But I think to work with people directly would be a huge benefit to me. And also them as well too, because there's a lot of things that I can't share on social media or on those platforms. And not to mention, for me, mentorship has played a huge role into where I am right now.
Fair. Just giving back.
Yeah, giving back. So, because I've seen how much it's helped me, I want to be able to help people in the same light. So I want to be able to be in some form of a mentor role for other people. I don't know if it's going to be like by a group setting or, maybe like a mastermind of some sort. I'm not sure, but I want to be able to give back to people more than just money. I want to be able to give back in terms of like knowledge and education. Exactly.
Let's get it.
Exactly. Because I want to build an empire and I want people to build empires for themselves as well too.
Absolutely dope. That's
How about you? I'm going to ask you as well. I'm going to put you on the spot. What's your 5-year plan?
5-year plan. All right. So I'm doing Black is the New Rich podcast now, but my big goal is for this to be a network. So I want podcasts under the network. So I don't see myself doing this on like, let's say year 6. I'll probably replace myself so I can run the network. Okay. So I just want to build up the numbers for this podcast. Yeah. So then I can have like different type of sponsorship leverage when the numbers are up. Yeah. Okay. So this will be a network. Okay. I'm gonna hold you to it. I'm gonna come back here in 2027. Yeah. This will be. We're gonna see the Black is the New Rich podcast network, or just the podcast? No. It'll be this will be a podcast still, but it might not be me running it. Yeah. But we'll have a Black is the New network, like Revolt TV or something. Okay. Like that, Okay. Yeah. I'm looking forward to it. I'm looking forward to it. All right, bro. Let everybody know where they can reach you. Instagram, and like email address.
Okay. So you can hit me up on Instagram. That's Who'sfly, WHOSFLYY 2 _. I got Who'sfly TV as well. That's my YouTube channel, as well as the Instagram channel as well too. Check out Cognitive Capital podcast, airing every Wednesday as well, where I'm the co-host.
Yes.
And just stay tuned, man. Honestly, like you can get in contact with me one way or another. Email is in my bio on Instagram. So yeah, hit me up if you need anything to do with mortgages. If you just want to talk about real estate and finances, I'm here to have every conversation about it, because I actually get a kick out of it. Like, I enjoy this stuff. So feel free to hit me up. I'm an open book, and I'm transparent, and I love to talk. So hit me up.
All right, bro. Thank you for spending time. I know you're a busy man.
Thanks for having me, man.
I appreciate it. And that's episode 11. That's a wrap. Till next time.